Hey everybody, and welcome to the first video from Chapter 9. Now, Chapter 9 starts our discussion on financial institutions, and we're going to open it up by looking at the financial system specifically from the lens of a small investor. So what we're going to do is we're going to set up the small investor problem and how they can invest in the market, and then we're going to contrast that with larger firms. And today we're going to do the first of those two things. So first we're going to talk about the financial development of the US and why it's actually important to the well-being of small investors. Then we're going to talk about problems facing small investors, and then we're going to talk about what the market and institutions are doing to reduce the adverse selection problem that arises from these types of problems facing small investors. So, this is really one of the biggest questions and critiques, really, of the United States' financial system, which is that it really doesn't affect standard of living, that it only affects the top 10%, the elites that really don't need any more money. Well, if you look at the graph below, while it's not a perfect or very tight regression, it is undeniable that open financial development is strongly correlated with dramatic increases in real GDP per capita. And now we can critique whether or not real GDP per capita is the most appropriate metric, but if you're looking at the countries on the right-hand side of this graph, the United States, Hong Kong, New Zealand, UK, Norway, Korea, China, these are all countries that have strong human development and strong middle classes and not just extreme elites like Qatar does, which doesn't have strong financial development. And so we can say that, at least to some extent, it is important to have a strong financial system and that it does trickle down into all sectors of the United States' population. But it's not equal the access to the financial system. And in particular, it comes down to two problems that face small investors: transaction costs and information costs. And what we refer to transaction costs as is the cost of making a financial transaction. Now, this we're going to get to in a bit, but it used to be that, especially with sophisticated trades, there was a transaction cost associated with the commission necessary to make a financial investment. And those costs have significant returns to scale. So it was relatively a lot more efficient to make transactions in terms of millions of dollars rather than hundreds of dollars, which of course meant that very sophisticated technical trades were only available to investors that have the funds necessary to make it a worthwhile investment. Now, information cost refers to the cost that savers incur when they try to determine the worthiness of a transaction. Now, a lot of day traders, most Americans in general, have very little understanding of the financial system. And some of the most profitable trades are the ones that are associated with the most risk. But even at the basic level, very few people understand what like an index fund is. And the information cost necessary to understand the transaction often is a significant deterrent to just households trying to invest in the financial system. And it's obviously inequitable between small investors and large firms because these large firms, they all are run by people with finance degrees and technical finance understanding, as well as the most sophisticated financial tools to analyze an investment, whereas small investors are pretty much the exact opposite. Uh, Now, I will note as we go through the last few slides that some of these concepts are becoming less relevant with the growth of zero commission trading and information platforms going from Robinhood all the way to your TD Ameritrade or Charles Schwab accounts that now often provide at the basics zero commission trading for basic transactions. Now, as I mentioned before, there are significant economies to scale when dealing with financial transactions. And what we mean by that is just the reduction in average cost that results from an increase in the volume of a good or service produced. And so the fees for large transactions usually don't go up in parallel with the size of the trade. So, as I mentioned, it takes some time, especially for any trade that is more complicated than a simple options contract or a simple stock trade. Anything more complicated than that, it takes some work and effort to make that trade. However, once we get to the place where the trade can incur, it really doesn't matter how many zeros you put at the end of the transaction. And so a lot of these transactions have a large fixed cost and then a small variable cost. So the larger the transaction, the lower the price is for commission or for entering the contract. That cost as a percent of the transaction goes significantly down. So these large financial intermediaries, they get significant economies to scale. Now, economies to scale are one of the biggest problems when we're talking about your return on investment. Since we're taking out a smaller percentage of the total investment for the cost of the transaction, that means that you don't need as high of a return to make, what's considered a worthwhile profit. Now, the other big problem facing investors deals with information costs, and that arises the asymmetric information problem, which is just that means that one party in a transaction knows more than the other party. And there's two problems with that. First is adverse selection, which means that investors don't understand the difference between low risk investments and high risk investments, meaning that we can get into really stupid and sticky situations. The other problem is moral hazard, which is that investors have a lot of problems understanding whether or not their investment is being used appropriately, whether or not it is working in their best interest. And these concerns aren't really unique to just financial markets. The most popular example are lemon laws with cars, where the dealer of especially a used car knows usually a lot more about the vehicle than the buyer. So we have this asymmetric information problem, and that's why in the United States, in most states, we have pretty strict what we call lemon laws, which means that there have to be certain guarantees from the seller, and if those guarantees aren't met, then the buyer can just return the car under a lemon law. But unlike a car, it's a lot harder to catch adverse selection or asymmetric problems in financial markets because it's hard to tell whether or not someone just doesn't understand the transaction because of asymmetric information or they just gambled and didn't pay off. So it's a lot harder to catch these problems, which means that lemon laws are a lot harder to implement in financial markets. So the easiest example here in financial markets is the expected value formula. So you should recognize this by now. We've brought it up in like 4 chapters. The adverse selection problem that means that specifically with investments with small and medium-sized firms is that it's a lot harder to calculate each P. And what that means from both small investors and small issuers of debt specifically is that they don't understand what P is, which means that the expected value is going to get miscalculated. And so what ends up happening is that with small investors, they're either just not going to invest in the security or they're going to overvalue the expected value and then end up finding out that they actually invested in a lemon. Now, on the flip side, this also hurts small firms because with a small firm, a startup company, they could have the best idea in the world, but there's no information to back up the firm and their business plan. They don't have a lot of financial data, they don't have a lot of proven sales, etc. You think about on Shark Tank, for example, the sharks usually ask for a lot higher equity stake in a company that doesn't have a lot of proven sales than ones that do have proven sales. And that also causes an adverse selection problem because, again, the investors don't know what P is. And so that means that the cost on the debt issuer is also going to be a lot higher than a large company like, Apple or something, even if they are more profitable. But there have been efforts to reduce adverse selection. And one of the big ones that the most important financial agency associated with reducing these costs is the SEC, the Securities and Exchange Commission, which regulates the securities markets. And so what they've done is first made that all publicly traded firms report their financial performance. And they do so in a couple different forms, but the most well-known one is called a 10K, which is a comprehensive audit of a firm's financial position. And so the SEC also put back in place some baseline mandatory accounting principles to make sure that all of the financial information is reported using the same standards, the same definitions, the same metrics. Also, firms must disclose all material information. And that just means that anytime they choose to do something that may invest or may change the fundamental value of the company, then they have to disclose it. So that means that and this really especially helps large firms, but it does trickle back to small firms. It does mean that there's a lot more information that is easily and publicly available because all of these financial statements reported to the SEC are publicly available and have to be available on each company's website as well as the SEC. So, especially with publicly traded companies, the amount of information that we now have is massive compared to where it was, a century ago. Additionally, the growth of the use of collateral has reduced adverse selection, especially from the debt issuer side. And the reason for that is because when you put out capital, it makes the investment a lot safer. It makes buying these small corporate bonds a lot safer because if the company goes bankrupt, there's guaranteed collateral to pay off the debt obligation, kind of like what a mortgage does, where the house is usually used as collateral. But there are still problems. The first one is that young firms still don't have much information in these SEC documents, so you can't really evaluate them at the same level as you would a firm like Ford, which has been around for decades and has decades of financial information. Additionally, risky firms may try and overvalue their securities, meaning that even under GAAP, there can still be some tweaking of the numbers, so the 10K may not be a perfect representation of the firm. Additionally, there are differences on how to report items on balance sheets, so there is a little bit of art to the accounting side of things on both the presentation of financial documents as well as the reading of financial documents. Additionally, material information can still be subjective, and the example that the book brought up to this is that Apple never disclosed how serious Steve Jobs' health condition was before he died. And for all of you that know Steve Jobs, he's really the backbone of what Apple was and the driving mind behind the company. So if Steve Jobs may pass away soon, that's probably considered material information to a lot of investors, especially trying to enter into long-term trades on Apple. Now, with that, we finished this video and you can now go on to the last video of chapter 9.